Well, hey everybody, welcome to another edition of Homebuyer Finance 101. It's been 6 months since I've done this live on YouTube, so I'm happy to be back bringing this class to you. Um, if you're new here, my name is Tim Kelly. I am a mortgage loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate dreams. We're going live today with something that is near and dear to my heart, Homebuyer Finance 101. This is a class that I have taught almost monthly for close to 12 years. So without further ado, I'm just going to jump into it and welcome. Homebuyer Finance 101, basically what this class is, it's going to cover a couple different things. When it's all said and done, usually it takes me about 90 minutes to get through all the information. But being that we're live and there may or may not be some interactions or some questions that come up if anyone is watching this, it is late in the evening right now, so I don't expect there to be too much, but usually we'll get through everything in less than 90 minutes, and it might be a little bit faster. So you can kind of see the timeline here. And if you are watching a recording, feel free to jump ahead to any of these sections you might be interested in. With that being said, we just want to kind of start off kind of dispelling some myths and talking about some misconceptions. So these are the top three things that I have seen in my experience that people have misconceptions about, or there are myths surrounding, and we just want to kind of just address these. So the first is the FICO score, or your credit score. This is one of the most important things when it comes to getting a mortgage. Ultimately, your credit score is going to determine what options and how many options are available to you, and ultimately what the cost is with your interest rate. If there's going to be mortgage insurance, it's really all determined by your credit score. So there are different tiers. Basically, if you have below a 620, you're considered poor. If you have above a 760, you're considered great. But every tier has different changes to the terms. So what makes up your credit score? Well, the number one thing is your payment history. Obviously, if you've been late, you're going to have some negative impact to your credit scores. If you, have just received your credit, you have not established a credit history yet, so that's going to slow you down a little bit. And then your credit utilization, the amounts owed in your credit cards, can have a major impact as well. But long story short, no one has perfect credit. Even people who've had credit for decades, they're often surprised on where their credit is, and some of them are happy, some of them are not. But generally, you're not going to see someone with perfect credit. You may not have it, and it just comes down to how you manage your balances when things get reported to the credit bureaus. Generally, you're seeing, especially first-time home buyers, in that 6 to 750 range. This is back a long time ago. I need to update that. Back in 2016, the average credit score was a 724. So it'd be interesting to find out where it is today. Moving on. So again, the most important thing is your payment history. Make sure that you are paying things on time. Do not be late. Set up calendar reminders to go in and check your credit card balances. Make sure you don't have any late payments. Make sure, when we talk about your credit utilization, the amounts owed, try to make sure, number one, that you're below the minimum, below your credit limit. Ideally, you want to get that down to 90% as quickly as possible. But from what I have read and experienced, the ideal range limit you want to keep your balances to is 10% of the credit limit. If you do that, you're maximizing the value your card is bringing to your credit score. But obviously, the lower you go, the more amount you have available on your credit, the better your score is going to be. But if you're in that 10 to 20% range, you're doing pretty good. So it's really important that you start to optimize your credit. Again, that's the most important thing. So if you are looking to buy a house now, jump on that, get your credit report pulled by a reputable lender who has experience with credit restoration, can give you some tips and tricks to get your credit score up. Even if you're far out, there are a lot of different ways you can get a free copy of your credit report. There's another video I did on my channel where we kind of dive and give instructions of how you can do that. So you can go ahead and check that out. And as far as the minimum credit score, well, you can get a mortgage with 500 to 520, and that's using an FHA product, which we'll talk about here later on this session. But the truth is, you don't need to have perfect credit. You can have 500, 520, still get a mortgage. It may not be the best, but it's still possible. You can even have no credit score, no credit history, and still get a mortgage. A lot of people like to say no credit is better than bad credit, and that can be true for a couple of reasons, which we'll talk about later. So other than the credit score, the next most important factor is your down payment. A lot of people have questions or concerns about the down payment. They're not sure if they have enough and what's really needed. So let's just chat about that. So this is another graphic here, just showing the average down payment. There are loan products out there where you can put down as little as 0 to 3% for first-time home buyers, and those funds can come from gifts. You can borrow them, you can save those, and the amount that you're going to be putting towards your down payment just depends on your product. It depends on which loan product you use, and ultimately your credit score is really just going to help determine which product makes the most sense for you, which is the most affordable option. But if you go with conventional financing, you're a first-time home buyer, you can put down as low as 3%. FHA is 3.5%. If you are a veteran or active duty and you are eligible for VA financing, that is 100% financing product, and so is USDA, which is a rural housing program. And we'll go through all of these here shortly and give you financing examples for each of them. So the minimum down payment for your first home is 0. You can use VA, you can use USDA, and there are other products which we'll talk about here shortly. So the max debt to income ratio, people think they're not going to qualify for a mortgage because they have too much debt, credit cards, student loans, car payments, what have you. So one thing that's important to note is that when you qualify for a mortgage, we are not saying that you can afford it. All we're saying is that you could qualify based on the mortgage guidelines. So it's really important, especially when you purchase your first home, that you do a monthly budget worksheet. Figure out what you're comfortable paying, what you can afford, and hopefully what you qualify for is more than what you can afford. But make sure you do a budget worksheet. There are so many available online. This is an example of one that's provided by Freddie Mac. You can just type, into any Google search or search engine, Freddie Mac budget worksheet, and something like this will come up. And I highly suggest you go through that before you talk to anybody. So what is that debt to income ratio, or DTI? This is a really important factor, and it's just how lenders determine if you are able to qualify for the mortgage. It's just a calculation using your gross monthly income and comparing that to your recurring debt, your liabilities that show up on your credit report. So this is kind of an example that we'll walk through about how to calculate debt to income ratio. This is a person earning a salary of $96,000, $8,000 per month. Again, we're looking at gross, not your net. So this is what you make before you contribute to your retirement, before you pay taxes, insurance, things like that, your gross income. And they have recurring debt of $500, and they're looking to get a mortgage of $2,500. So the total debt that we are using is $3,000. So you just take $3,000 and divide it by 8,000, and you get a decimal, multiply that by 100, and now you get the percentage of 37.5% is their debt to income ratio, their total DTI. So you could, generally get an idea of what your DTI, what your debt to income ratio is by doing a similar calculation with what you know. Just know we're not looking at your lifestyle. We're not looking at how many streaming services you pay for, how many times you go to Starbucks or eat out. We're simply just looking at what debts show up on your credit reports. Okay. So the max debt to income ratio depends on the loan product that you're using. Conventional financing, Fannie Mae, Freddie Mac, typically you can go up to a max debt to income ratio of 50%. FHA, you can go above that. It's a little bit more lenient, 55%. VA, there really isn't any written rule about the max debt to income ratio, but typically, you're looking at that 50% range, and USDA financing is the most conservative at about 45. What's important to note about these ratios is, it's not set in stone that if you are below this, you're still going to get approved. Most, if not all, mortgages are run through an automated underwriting software program, and it will tell us if you are approved at that debt to income ratio. So just because your ratios are below these percentages that I've just shown, it doesn't mean you're going to get approved for the financing. So let's just dispel the myths. You don't need to have perfect credit. You can get a mortgage with 500. You don't need to have a down payment. There are 100% financing products available, and your max debt to income ratio is generally you can qualify for a lot more than you can afford. We can go up at over 50% of your gross monthly income for your total debt to income ratio. But again, check with your loan officer that you're working with. There are overlays, sometimes changes to these. Not every lender follows the guidelines to the T, so just check with them. So why Homebuyer Finance 101? Why do I do this class? And that's because there was a study done, and 68% of millennials had regrets when purchasing their first home. And this was back in 2018. I think that has only stayed the same, maybe even gone up a few percentage points, especially in a market where it's really competitive. People are moving really fast. Maybe they're waiving inspections. But a couple of reasons why there were regrets back in 2018 and why that might still be the case today is that they thought they were overspending for the down payment. They underestimated ongoing costs, and they were just settling for something that's not quite right. And I think if you look at the market that we've been in over the last couple of years, I think that just has been the case. People are really waiving inspections. There's limited inventory. They have to settle for what's on the market. It may not be the perfect home for them. And again, the underestimation of what it takes to maintain a home, I think is something that a lot of people don't talk about. So a lot of people approach the mortgage process just asking the wrong questions. They focus on the interest rate, they focus on the closing costs, but those are the wrong questions to ask. So why is that? And that's because there's risk. Focusing on just the rate and the cost doesn't take into account all of the risks. And again, there's different pros and cons for each loan product. And when you're purchasing your first home, you have options that won't be available to you later. So you really need to make sure you're analyzing the risk of using that product, because home prices change. They can go up, they can go down. Right now, we're in an environment where home prices, depending on where you are in the country, might be softening a little bit. There is a cost of sale. So if you do overextend yourself and then all of a sudden you just can't handle it because the mortgage payments are too high, or the maintenance costs are too high, or you just don't like the house anymore, the cost to sell a home is typically higher than the cost to buy a home. Again, we talked about the maintenance costs. I like to think, at least, it depends on how old your home is and where you are. There's a lot of different areas in the country that the homes get a little bit more weathered quickly than other parts, but generally you're going to be spending about 1% of the home's value in just maintaining it. An older home, that could be 2%. So if you're buying a $500,000 home, you're just spending $5,000 a year just to maintain it, not to enhance it, bring up the value, just to keep it functioning, keep it livable. Opportunity costs, if you put down too much, and what did you lose out by not investing the money or doing something else with it? Lack of liquidity. When you put the money into the house, it's in the house. You can't access it easily. And then obviously it's a long-term commitment when you get a mortgage, and life can change. So there's a lot of factors that can impact the risk. So what are the right questions to ask? So I'm not just going to read these off the screen here, but go ahead and pause it and you can just kind of review these. These are important internally to ask these questions, or if you're buying with someone else, have a discussion about each of these points. Make sure that homeownership is the right move for you, and it's the right time. Okay, it's nothing wrong with renting a home. Nothing wrong with saving a little bit longer, staying in your situation if you have a good one for a little bit longer, waiting for the right time in the right home. So the path to homeownership is different for everybody, but generally, this is a process that most purchases will go through, and I'll kind of walk through this process with you here. When we do this, we're going to look at the different loan products. There are different programs, conventional, Fannie Mae, Freddie Mac. They are the GSEs that create conventional financing. FHA, VA, USDA, these are Ginnie Mae products. And then we have non-conforming jumbo loans. And each of these has fixed rates or adjustable rate mortgages. And there are other products like non-QM bond loans as well. So are you ready to buy? Let's just go ahead and start the process. So this is, again, asking the right questions, not the wrong questions, doing a household budget, and then looking to make sure it's the right time for you. Again, budget is paramount. Make sure you do the budget and sit down and complete it and really take the time to do it right. And then ask yourself these 3 questions: why you're buying home in the first place, where value is headed, and where interest rates headed. Make sure the time is right for you. So homeownership is the American dream. I still believe it. I see it every day. People have studied it and said it's still one of the best things that a family and individual can do. And there's a lot of benefits to it. It's a leverage investment. You're paying for housing whether you own or rent, unless you're lucky enough to live for free with your parents or relatives. If you're doing a fully amortizing loan, it's a form of forced savings. You're paying down that loan balance every month. It's a hedge against inflation, which is something that is important in today's environment. And there are tax benefits. Talk to your CPA about if you would be itemizing, taking advantage of the tax benefits of owning a home, or just continuing to take the standard deductions. Your CPA can easily help you, or your accountant can help you, see if there's a tax benefit to homeownership for you. Where value's headed. So I just pulled this up earlier today, and this is just a graph just showing you what the expectations for prices are over the next 5 years. Just understand real estate is local. There's going to be regional differences. This is just a national average where you're expecting home values to continue to rise. And these are good. We don't want home values going up too fast like we did the last couple of years. We want, stability. We want a slow, steady growth, keeping up with jobs and income. So 2 to 4% is usually very healthy, and that's what we have seen historically. But understand, real estate is local. Talk to your local real estate agents. Figure out what's going on in your market where you are. And again, this is just illustrating that different parts of the country are seeing, this current environment a little differently. This is from the end of last year, and some of these have changed a little bit, but generally speaking, there are parts of the country that are doing better than others. So where are mortgage rates headed? This is Fed week right now, so it's a really important discussion that we're having with our clients. And just understand there are many factors that impact your interest rate. There are many factors that can change rates quickly. I've done a video on this in the past, and all I will say is rates will rise like a rocket and fall like a feather. So these are just a few things that can impact interest rates. Right now, it's Fed week, like talked about, number 4, the Federal Reserve. They don't control mortgage rates directly, but they can have an impact on it. Right now, they were meeting today, their meeting ends tomorrow, and there's going to be a press conference, and the expectation is that they're going to drop the Fed's fund rate by 0.25%. That is not a direct correlation that mortgage rates are going to be dropping by 0.25%. If anything, the market has already priced in the 0.25% drop that the Fed is going to be doing tomorrow. There's a very high amount of certainty that we were going to see a 0.25% drop, and so the market started pricing that in. Wall Street doesn't like to be surprised, so if there's something that is different, that can have an impact, causing rates to move. And again, they can move very, very quickly. But check out that other video. We go into detail on all of these different factors and what can cause rates to go up or down. Historically, you can see there where rates are, and we're still in a pretty good market. But again, rates can change at a moment's notice. And this is a moment in history just kind of showing you what can happen and how quickly it can happen. So this purple line was a 200-day moving average where rates are. And when this price is high, that means the interest rate to consumers is low, okay? And you can see here there was a significant 3-day drop. And this is just talking about what I said earlier, that Wall Street doesn't like to be surprised. This moment in history was when Trump beat Clinton for the presidency back in, was it 2016? And you can see here we had what's called the Trump bump. Stock market went on the tear. As a result, mortgage rates went up about 0.5% in a matter of 3 days. And that can have a major impact on what you qualify for on a mortgage. So again, make sure you're staying in close contact with your loan officers, keeping up with mortgage rates. And this is just a historic graph just showing how rates have changed over the last couple of years. I won't bore you with the details, but mortgage rates are forecasted right now, are being forecasted right now that they will be improving, they will be dropping. So this is just a graph kind of showing you different estimates that we have. Just understand these are forecasts, just like the weather. It's not always going to be exactly correct. And this is just based on what we know right now. There are things that are going to be happening in the future that can impact the markets and impact interest rates, and these forecasts will completely change. But we're not expecting interest rates to fall below 6%, at least at the moment. We're not expecting interest rates to ever go back to the levels we saw in 2020, 2021, where they were below 3%. We're just looking for rates to stabilize in the mid to low 6% range, and that is what they're forecasting. So where are they now? So this is a primary mortgage market survey that's done by Freddie Mac. It is published every Thursday, and this is usually what the media is reporting on when it comes to the average interest rates. And right now, they're in that low 6% range. This is back from last week. They've improved a little bit since then. If you look at today's average mortgage rates using a service called Mortgage News Daily, you can just type in MND mortgage rates into your search engine, and you'll get this website usually as the first result. It's a very helpful website to kind of keep track on where rates are. And you can see here they're in that low 6% range with conventional. VA has a slightly better interest rate than your conventional financing, and that's below 6% at the moment. So you're not locking in your interest rate until you have a ratified contract. So don't worry so much about the interest rate right now if you are just starting this process. And a couple questions that you should be asking your loan officer is when you can lock in the rate. Do you have a lock and shop program? If you're out there actively looking for properties and all of a sudden there's something that happens that causes mortgage rates to skyrocket very quickly, you want to know if your loan officer has a lock and shop product, a product that lets you lock in your interest rate while you're shopping for a home. Not everyone does. It's not always the best strategy, but again, this is your mortgage. You're the one that's making the mortgage payment. Make sure you are talking to your loan officer about that. Because what happens if rates change? Well, after you lock in, if rates change, if they go up, you're protected. You're not going to see that increase to your monthly your interest rate. If rates fall, you want to also ask if they have a rate renegotiation or a float down option. Okay, so let me just kind of reiterate, this is very important, especially in this market that we're in right now, with everything going on and interest rates hopefully maybe getting a little bit better over the next couple of weeks. Number one, typically you're not locking in your interest rate until you have a ratified contract, until you and the seller have agreed to terms, because at the end of the day, the home that you're purchasing is the collateral. If you stop making mortgage payments, they're going to take the home. They're not going to garnish your wages. So you need to identify the property that you're purchasing, and once you have, that's what's getting locked in. If you are working with a loan officer, a couple of questions you would ask them before moving forward with them is, do you have a lock and shop product? Okay, if interest rates all of a sudden or start changing and getting worse underneath your feet while you're actively looking for a home, a lock and shop product allows you to lock in the interest rate while you shop for a home. Like I talked about, you haven't identified the collateral, so there's some additional costs. The interest rate's a little bit higher than your average 30 or 30-day lock, but it's important and something that could be beneficial. And when you do lock in your interest rate using the lock and shop product, or you have a ratified contract, what that does is that stops your rate from going up as long as you close within your lock period. If interest rates go up, you are protected. If interest rates fall, you want to ask your loan officer if they have a float down or a rate renegotiation policy, something that lets you take advantage of the improvements after you've locked in the interest rate. Okay, so very important that you ask those questions. So, pause for questions. I don't see any, but if you do have any questions, you can type them in the chat, and I can, obviously address them when they do come up. And what you need to do before you start shopping for a home, we're just going to move on to section 2. And this is really where you start to establish your relationship with your real estate agent. You start to establish the relationship with the loan officer. It's important to kind of know what type of property you're going to be purchasing. It really just kind of depends on where you are in the country, about the types of homes that are being built or have been built there. But it's important to kind of communicate the type of home that you're looking for to your loan officer and obviously your real estate agent, so they show you the right houses. But not all lenders are created equal, and this is just something I like to explain to a lot of first-time home buyers, because what I have found is that many of these clients have purchased a car, maybe multiple cars, before they've ever purchased a home. So what I want to do is kind of compare the mortgage industry to the auto industry. And I think this will really help put everything in perspective. So you have primary mortgage markets and secondary mortgage markets, okay? Think of it like this. The secondary mortgage market is like the auto manufacturers. They're like the Ford, Toyota, Chevrolet. And then you have the primary mortgage market. That's the mortgage dealerships, just like the car dealerships. That's where you have mortgage bankers like myself, mortgage brokers, credit unions, and banks. We're not creating the mortgage products. We're selling the mortgage products that are created in the secondary market by Fannie Mae, Freddie Mac, Ginnie Mae, and any state and local agencies offering bond products. They're the manufacturers of these mortgage products. We're the mortgage dealers. And just like when you go buy a car, if you're getting a conventional loan, it's typically the same conventional loan, same vehicle, no matter what dealership you go to. Okay, it's got a steering wheel, 4 wheels, 2 seats, a trunk and a hood, whatever type of vehicle that you're buying. It's typically going to be the same one, no matter what dealer you go to. The difference is the cost for that vehicle and your experience purchasing it, and then how they help you maintain it and the cost to maintain it afterwards. So when you're getting a mortgage, think of it like just like buying a car. You're talking to a mortgage dealership. You're talking to a mortgage salesperson, just like a car salesperson. At the end of the day, that loan officer is only going to sell you the cars on their lot. Okay, so they're not going to tell you about some great product that some other bank has, because they're not getting paid on it. So you need to do your due diligence. You need to interview multiple lenders. You don't need to apply with multiple lenders, but you need to interview multiple lenders and find the lender that you want to work with, someone that you can trust and know that they typically have whatever type of vehicle that you're looking for. They probably have it on their lot. They probably have it in their product suite, and they should be able to help you. So here's a couple questions that you could ask the loan officer when you're interviewing them without doing an application and without asking what their interest rate is. And that is, what's your experience with my loan type? So we're going to talk about the loan types here. And if you like one, FHA, conventional, what's your experience with conventional financing? What's your experience with VA financing? Communication is the most important thing in this process. Things can get bumpy, can get a little shaky, and you want to make sure that you have established how you'll be communicated and how often you'll be communicated, what to expect in the process with your loan officer. So how will you be communicating with me and my agent during this process? While communication is very important, there's a lot of other things that can come up in the process. So just ask them, hey, walk me through your process. How are you going to be able to meet my contingencies? Because I still live in a very, and trying to buy in a very competitive market. I need to move quick. And how are you personally going to ensure that my loan gets done and closed on time without any surprises or delays? And then finally, what fees do you charge? I've heard some lenders will charge for pre-approvals or credit reports up front. It's your decision whether or not you want to pay those, but just make sure that you ask that question. You're not surprised after the fact that you've applied. So that's what fees do you charge. So are there any upfront costs? And then in a competitive market, how can you help me get under contract? And that's something where working with a local loan officer can really have a lot of value. Help you get under contract. They probably have a relationship with the agent or the brokerage that's listing the property. They have a reputation locally that can help you win the deal. And all of us loan officers, we have something called an NMLS number, and it's usually on everything we send to you, every email, every financing scenario. And you can always look us up and get a resume, basically, of our work history. Some not just in the mortgage industry, but also every other jobs that we've had. If there's been any complaints filed, you can see those. You can see that where we're licensed, what states, and a lot of information. And so you just go to that website, nmlsconsumeraccess.org, type in that number that you see on our communications and financing scenarios, and you'll get basically a resume for every loan officer. But really do your due diligence, interview, and just understand that when you find someone that you know is going to do a good job for you, that you trust, that's where you can do your pre-qualification and pre-approval. Okay. Typically, you don't have to get pre-qualified or pre-approved by multiple lenders because, again, we're not the ones creating these products. There are overlays, but generally the amount that I approve you for is going to be very similar to the amount that someone else approves you for. Where you might see a difference is, again, that loan officer's experience working with a client in your situation, looking with your product. Product knowledge is very important. So you want to make sure that you're working with someone who has a high mortgage IQ. But you're going to get pre-qualified before you get pre-approved. That's just where you enter the information on the application. There's a lot of new technology that allows the loan officer, the lender, to verify your income and assets while doing the pre-qualification. If you apply online electronically, they can often link your employment and your income, your assets to the application, which really helps speeds up the process. But a pre-approval basically takes your application and we're getting documentation verifying everything on the application. We're getting your driver's license, your pay stub, your bank statements, and we can take those and make sure that the amount that you put and said that you make every month matches your pay stubs. So that's what a pre-approval is. A pre-approval carries a lot more weight and has a lot more value than a pre-qualification. So a couple of pitfalls to avoid at this point in the process when you're interviewing loan officers. Try to avoid negative items on your credit report. Too many inquiries. Again, shop around. That's perfectly acceptable, but don't overdo it. 2 to 3 at the most is pretty much all you need. And really be mindful of not falling behind on your bills. Don't be late. You've got a lot going on. You're looking at houses, you're moving, but make sure you set up those calendar reminders, because I've seen it happen in the middle of everything. There's a late payment and it can really impact your terms that you're going to get. Don't co-sign on any debts with anyone. Don't change your job without talking to your loan officer first, and don't ignore your lender's requests if they're asking for documentation. Just turn it in as quickly as you can, because they're probably asking for it for a reason. And if you are making any deposits, make sure you keep track of them. This is a financial transaction, and we're going to get bank statements, and anything that's a large and unusual deposit, we have to make sure that it's from an acceptable source, especially if that's going to be used when purchasing a home. And then just keep in communication with your loan officer, because guidelines can change without notice. Loan officers or lenders can add overlays that, things can change. It's not often, but you want to make sure that they're communicating those changes to you. So I don't see any questions in the chat, so I'm just going to move on to the programs. This is kind of the um, meat of the session here. And this is after you kind of got pre-approved, you got your application in, you got the documentation in. This is where you start to um, get some financing scenarios. So what I'm going to do um, is just walk through each of these scenarios, assuming the same borrower, so we can kind of get an apples to apples comparison. And if you're working with a loan officer that has experienced a lot of product knowledge, what they're generally going to do is they're going to walk you through and educate you about the different products. Okay, it's like, for example, someone in your situation, this is what conventional financing looks like compared to FHA, VA, USDA, and so forth. You're the one that makes the mortgage payment. You're the one that determines which product you want to use. I believe as a loan officer, it's our job, our duty to make sure that you're aware of all the options that are available to you, even if they're good or bad. I know me personally, I have trouble walking down the aisle in the grocery store. If I want to buy chips, I have to look at every kind of chip that's available before I decide on which one I want. Or ice cream, I have to look at all the flavors in the freezer before I choose the ice cream that I'm going to be taking home with me that day. And so I believe most consumers have the same thought process, especially with the largest purchase that they're ever going to make in their life with their home. And so I think it's only a disservice if they don't show you all of these options. They don't provide you an education about these different products. So conventional financing, there's a couple bullet points up there. You can pause it for some information, but you can get a conventional loan, over 1.2 million if you're in a high cost market, up to 806,000. Pretty much everywhere in the country. FHA, you can get an FHA loan again over a million. VA, there's no max. It just depends on your entitlement and where you're purchasing. USDA is a rural housing product, so there are purchase price caps, and then jumbo again is typically anything above conforming loan limit for the area that you're buying. And then non-QM, these are things that if you don't fit the product mold for those products, that's a non-QM or non-qualified mortgage. It has options, and there are different loan sizes, requirements for that. So let's just kind of walk through these different products, assuming the same purchase and using them, again, seeing an apples to apples comparison. Okay, so this is a single individual. They're first-time home buyer. They've got good credit, 740. They're making 95K a year, and they're W-2 with a more than 2-year work history. They got $50,000 in the bank and only $750 a month in debt that shows up on their credit report, from credit cards to an auto loan. They're looking to purchase a townhome for $525,000. Real estate taxes around $6,000, homeowners insurance around $1,400, and the HOA fee is around $120 a month. So what we're going to do is we're going to just walk through each of these products, each of these vehicles with that person using it, and see which one is the right fit for them. So they can use conventional financing. They can put down as low as 3%. They've got good credit. Their debt to income ratios are going to be a problem. And they do allow for seller credits. They do allow for gift funds. And if you are borrowing more than 80% of the home's value, there is mortgage insurance. So with mortgage insurance, there's different ways that you can pay for it. There is monthly paid, which is the most common, especially in this environment where interest rates are expected to fall. People are often better going with monthly than the other options, but it's important that you know that they exist. Single premium is a one-time fee you pay at closing. Lender paid, we're going to pay the mortgage insurance for you, and that usually comes at a higher interest rate than your monthly or single premium mortgage insurance. Financed, we're taking that upfront cost and just rolling it into the loan. And then the split premium is a combination between the monthly and the single. So which one makes the most sense for you? Again, situations can be different. Right now, if you're going to be refinancing the home, you may not want to go with that one-time fee just to have interest rates fall, and you end up having to refinance a couple of months down the road, and you still need mortgage insurance. Whereas monthly, you've only been paying the mortgage insurance for the time that you've had the mortgage, which is why that's the most common option right now. So what we do is we put these in a comparison using something called a total cost analysis, and that is something that you can see up on the screen here. So what we're doing is we're comparing the rent, $3,300 plus $50 a month renter's insurance, to purchasing the home for $525,000. And just keep in mind, again, this interest rate is something that I priced out earlier in the year. I just didn't update it because this is just for educational purposes only. You can see here I created this back in March, and the interest rate for this was 6.625. Not too far off from where we are right now, but just, don't beat me up over, the rate that you see here on the screen. It is what it is now, and this is just to kind of give you an idea which product makes the most sense for this particular purchaser. So they buy this home for 525. They put down 3% using conventional, and they have a monthly payment of $4,180. That is a total housing payment. So that includes everything for the house: the principal, the interest, the taxes, the insurance, and that $120 a month HOA fee. It does not include maintenance. It does not include utilities. It does not include, all of the other, services that you might be already paying for. It's what the home payment is, the housing payment is. The PITIA, so principal and interest, taxes, insurance, and association fees. If you don't pay any of those, you could lose the home. And so you're going to be going from $3,350 up to $4,180 using this product. Your cash to close, assuming that 3% down payment plus all the closing costs, prepaids, and escrows, using closing costs here in Northern Virginia, you'll need right over $30,000 at the closing table. So if you compare the net monthly payments, again, if you're itemizing your taxes, it brings the total payment down because you're going to get a larger refund at the end of the year. So comparing a net payment, I believe this is in a 20% tax bracket. Your net payment after the tax savings would be about $3,700, but you still have that cash flow of the $4,180 that you have to be paying each month. The rent versus principal over 36 months. So this is where you say that you're paying either your landlord's mortgage or you're building your equity. So if you were to continue to rent at $3,350, you'll be spending around $126,000 over the next 3 years. Whereas if you purchase this property at that interest rate, you would have put almost $18,000 into your equity with that forced savings. Your estimated net worth, and this is what often is referred to the biggest benefit of home ownership. There's really no quicker way to build your net worth than through real estate. I know there's lots of meme coins and Bitcoins and things that perhaps have a better ROI right now than home ownership, but historically it's the best investment. And this just shows you if you purchase the home and waited 7 years, your estimated net worth would have increased to $257,000 because you would have built a lot of equity. Whereas if you continue to have that 50 grand in the bank earning 5%, it would have only grown to about 71,000. So it just shows you, the benefit of home ownership when it comes to your net worth. So if you put down more than the minimum, you're at less risk of default. So being at less risk of defaulting on the loan, you get some better terms. So we're comparing a 5% down conventional now. You're bringing more to the table. You can see that the cash to close has gone from 30 to 40. The monthly payment just over $4,000 a month. So you're saving about $100 compared to the 3% down option. If we look at the net monthly payment, it's a little bit more in line, still more than what you're paying in rent. Same thing, you're building equity versus paying your landlord's mortgage, and your estimated net worth down the road. You can see here it's definitely an opportunity cost. Taking more money out of the savings, putting into the house, isn't always the right move. Talk to a financial advisor. We are not financial advisors. We sell debt. Okay, so don't think your mortgage loan officer is advising you how to increase your net worth. This is just for illustration purposes only. And again, we just want to make sure you're aware of all the options and the implications each of these have. So conventional financing with 3 to 5% down. And then we will look at FHA. A lot of people like FHA because it has a lower interest rate. It has a lower interest rate because it is a product of the government. It is backed by the government. So investors value that because if there is a default, they'll make some of their money back because it's insured by the federal government, Ginnie Mae. You don't need to have perfect credit. You can put down 3.5%. There is, no matter what your credit score is, what type of property you're purchasing, you're going to have mortgage insurance. It's the same for everybody. Again, the government sees everyone as equals, and so everyone's going to be paying the same mortgage insurance premium, and that's a 1.75% that is upfront. That could be paid at closing or financed. Usually it's going to be financed. That's how most people do it. And then it has monthly paid mortgage insurance. And the difference between the conventional versus FHA, monthly mortgage insurance is FHA's mortgage insurance is required for life, whereas conventional will ultimately stop after 11 years or when you hit 78% loan to value. So just looking at the numbers of, we're looking at a 525, again, the same property being purchased. The cash to close is a little bit higher than the conventional 3% down option. And that is because the minimum down payment is 3.5, not 3. The monthly payment is pretty much similar, and that's because of their credit score. If their credit score was lower, a 640 as opposed to a 740, then conventional would have been more expensive, making FHA a better option for them. But in this case, because of their credit scores being good, FHA isn't more affordable. The interest rate is lower, but don't be fooled. You can see, even though with a lower interest rate, the monthly payment is about the same, I think a little bit higher, what we saw with the 3% down conventional. And the cash to close is higher. So why would you choose this? I'm not quite sure, unless there's underlying reasons why you can't go conventional. Again, the net payment comparison, the rent versus principal, your net worth still a lot higher with FHA. VA, so this is only available if you are a veteran or active duty service member. You don't have to be a first-time home buyer to use it, but it's a phenomenal product. So I'm just going to kind of breeze through this pretty quick. It allows for 100% financing. So you'll notice the cash to close, just under $15,000, and that's just the closing costs, prepays, and escrows. You are able to finance 100% of the home. There is an upfront mortgage insurance, just like FHA. You can be exempt from it, but in this scenario, we're showing that the person was not exempt, so they are borrowing more than what they purchased the home for. Again, look at the risk. Make sure you have a conversation. Is that the right move? Is that the right product if you are able to use something like this? The interest rate is better than conventional. Again, similar to FHA. It's backed by the government. Investors like that. Net monthly payments, rent versus principal over 3 years, and your estimated net worth is higher. And USDA. So if you are buying a property that is in a considered to be in a rural area, you can look it up to see if it's eligible for USDA financing. Again, this is not a first-time home buyer product, but generally you see a lot of first-time home buyers use it. It's just like FHA or very similar, except there's no down payment. It has upfront mortgage insurance and monthly mortgage insurance, which is required for the life of the loan as well. And we're just looking at that same property, but it's eligible for USDA financing. Again, it's 100% financing, so you are borrowing more than you purchased the home for. So you're kind of upside down right out of the gate. And that monthly payment is a little bit lower than what we saw with FHA financing. Again, because the interest rate is a little bit better, and the mortgage insurance is lower. The net monthly payments a little bit more in line with renting, the rent versus principal over the next 3 years, the net worth 7 years down the road. And what you do is you just take the options your loan officer gives to you and you put them, side by side, and you kind of compare which product is the best for you. And you can see here that it's kind of like a seesaw. The option where you're bringing the most amount of money to closing has the lowest monthly payment, and that's just math. You're borrowing less, you're going to pay less. Okay. The options where you are, using these 100% financing products, they have in this scenario with these interest rates slightly better financing terms than your conventional or FHA loans. Okay. With the minimum down payment 3 and 3.5%. So if you're able to use 100% financing, maybe that makes the most sense for you. But again, just understand that you don't have equity. You're not going to be able to just turn around and sell the house a month or two later and expect not to have to bring money to the table. So these are really, buy and hold for the long-term products where you have to, build that equity with your monthly payments, that forced savings, really for them to make sense. But you just compare which options makes the most sense for you. Communicate that to your real estate agent and go from there. So again, no questions in the chat. If you are watching this recording, feel free to put your questions in the comments, and I will monitor them and try to get back to you as quickly as possible. So now that you've interviewed your agent, interviewed your loan officer, got pre-approved, gone over the numbers, like what happens next? So a real estate agent is really the person that's going to hold your hand throughout this entire process. Us loan officers, generally, we just handle the financing and we're done. So make sure you are working with a great agent, especially now where there's a decoupling of the buyer agent commission. It's not a guarantee that the seller is going to pay your agent's commission. So make sure they earn their keep because they're going to establish timelines, help you determine locations, understanding the current market conditions, and you can read the rest. So again, I've touched on this briefly, but it is not a guarantee that the seller is going to pay your buyer agent commission. So they help you write the offer, and again, everyone's market's going to be a little bit differently. Right now, we're starting to see appraisals and financing contingencies and home inspection contingencies come back, and they can range depending on who you're working with and how quickly you need things done. But the thing that I want to point out here in this screen is that even if you're doing 100% financing, you're still going to have some upfront costs of purchasing a home. You're going to have to pay the home inspection, usually the day the home inspections are done, and that can be $300 to $500 or more, depending on how big the property is. You're going to have to usually pay the appraisal fee upfront, and that can range from $500 to $600. And the reason why you're paying for those upfront is because the home inspector and the appraiser, they did their job really in the beginning of the process, and they don't want to wait 30 days or 60 days to get paid. So they usually require the payment upfront. So the home inspection, you're going to pay the home inspector directly. The appraiser, you're usually it's a pass-through fee that your loan officer is going to collect from you, and that fee gets passed on to the appraiser. Then you have something called an earnest money deposit, or an EMD. This is kind of like a good faith that you're going to put money up and get some skin in the game. And usually that can range depending on where you're purchasing a home from, a few $100s to 1% of the value to, tens of thousands of dollars, depending on how competitive and how serious you want the seller to take you and your offer. But if you miss any of those contingencies, the seller has a right to take that money, take that deposit back if you default in the contract. So again, get everything tied up nicely and neatly with your agent and your loan officer to make sure you do not lose that earnest money deposit. And then there could be a condo questionnaire if you're purchasing a condo. And there's other costs just depending on where you're buying and who you're working with. But generally, those are the ones that you're going to have to pay upfront. And all of your closing costs can be paid, depending on your loan product, can be paid by the seller. It just depends on the product that you're using. Again, your market, if you can negotiate for a seller credit or not. But your seller cannot pay your down payment. You have to fund those as well, or you have to fund those or be getting gifts, borrowing from a retirement account. There's some different ways that you can do it, but the seller is not able to give credit that could be used towards a down payment. So if you are negotiating with the seller to get a seller concession, a seller credit, you want to make sure that it gets applied to your closing costs, and the seller's not going to get some of that money back. So again, communicate with your loan officer and your agent to make sure that all of the seller concessioning is being a benefit to you. So going back to the process here. So you've gone and looked at properties, you found one that you're interested in, and you want to have the seller accepted your offer. So a couple important things to note. Remember to avoid these pitfalls, too many inquiries, falling behind in bills. You can see the rest. Very important. You're not done until you get handed the keys at the closing table. So make sure you're staying on your game, your A game, and understand that guidelines can change. Hopefully, your loan officer is just keeping up with your employment documentation. You're communicating any changes and things that have happened, and you're not going to be surprised that you go to write an offer, then all of a sudden something changed in the product guidelines, and you don't no longer qualify for it. So again, just make sure you establish that communication with your loan officer. And appraisal contingencies, just want to kind of point this out that the lender is not the one doing the appraisal. It's there's something called an HVCC, Home Value Code of Conduct, that every lender and every bank has to follow. And when the appraiser goes in there, it's like checking the car's value on Kelley Blue Book. They're not going to be looking for health and safety issues typically, unless you're using FHA, VA, USDA financing, but they're not going to be looking at every nook and cranny like a home inspector is going to. So even though you're getting an appraisal, that doesn't mean that that is a home inspection. A home inspection is like taking a car to a mechanic before you buy it. And again, the appraisal is like just checking the value on Kelley Blue Book. So if you're buying your first home, I highly recommend doing a home inspection. I highly recommend you being present when they do the home inspection, because the home inspector generally is going to tell you so much about the house. You really want to be there to take it all in. And then there's a condo questionnaire. When you're purchasing a condo, not only do you have to qualify for the condo, but the condo has to be eligible for the financing as well. So there's usually a questionnaire that the condo association has to fill out, depending on the lender and the product that you're using. And again, it's really just to protect you, that you're not buying into a condo association that's failing. And they have to, a couple months or years after you're purchasing the property, they have to increase the HOA dues, the condo dues, to cover some major repairs or renovations, which can happen regardless of what the questionnaire says. But again, it's just a lot of due diligence that we want to make sure that the condo is financeable. And moving forward in the process, so just simplifying the financing process, because we pretty much have got you from the start of deciding whether or not it's the right time to purchase the home, getting pre-qualified and pre-approved, looking at the different financing options, to writing an offer, communicating with your agent and your loan officer. So walking through everything that you see here on the screen, the process is pretty much the same no matter where you go. It's just, again, how quickly you get there, how the communication was, but generally, when you go through the financing process of purchasing a home, it's very similar, because at the end of the day, you're getting that same vehicle no matter where you go. It's just a different person selling it to you, a different team communicating and relaying information to you and educating you. So there's no questions, but if you do, please comment, kind of bring everything together. Establish the household budget. That's the very first thing that you want to do if you want to buy a home. Create a budget worksheet. Schedule a buyer consultation with a real estate agent. If you were sent this video by an agent, that's a good person, a good place to start. Then schedule a time and date to get pre-qualified and pre-approved. Interview the loan officers. Try to do it on the same day or the same week, so you're getting the same kind of feedback on products, interest rates, and once you find someone that you're comfortable with, get your application into them, go through the process, get the documentation they ask for, let them pull your credit report, and go from there. Then review those financing options with your loan officer. If you start to see any red flags, maybe it's a good time to start a conversation with another loan officer during this process, but make sure that they're taking the time to walk you through your different financing options, the different pros and cons for the product that you're using. And then start your home search with the real estate agent. When you're interested in a property, you can usually send that property over to your loan officer. They can update numbers for you. If the numbers look good, the property looks good, make the offer. But that is it for today. If you have any questions, there's my contact information. But I hope this was helpful, and if you have any feedback or you're checking this on the replay, again, I'll monitor the comments. We'll do another one of the Homebuyer Finance 101 classes in about 12 weeks, trying to keep up with the current market conditions, interest rates. So if you are still looking to purchase your first home, check back. We've got a lot of other great content out on our channel, and a lot more coming out the fourth quarter of this year. So be sure to check out those. And if you ever need anything, don't hesitate to reach out. But I appreciate you for watching, and hope all is well. Thanks so much.